All right, hey, welcome to the video. My name is Blake, aka Forex Money Flipper. You see my hat with the dolphin on it, that old show back in the day, Flipper. Was the name of that dolphin. So this video is going to be for a friend of mine in Africa. Her name is Grace. She's a friend of my girlfriend. She asked me to help her understand Forex. Okay, so the first thing we're going to talk about is getting on the right time zone. Okay, the time zone that's most important to know about is the New York time zone. Okay, so so number one, right? It's basically called EST, right? So this is Eastern Standard Time. The reason that this is so important is because everything revolves off of basically this, because the New York Stock Exchange is the big session that you want to be awake and trading. Okay, so this is going to be, the EST equals the New York time zone. Okay, New York time zone. All right. So when I talk about times, I am going to be using Eastern Standard Time. Okay. So the time that's most important to be trading. Now let's talk real quick about pairs. Okay. So we're talking about. We're going to divide this. We're going to talk about the best pairs to trade, right? And we're going to just we'll stick with black for right now. Best currency pair or pairs. Now the two that I'm going to recommend that I use the most is going to be basically GBP USD. Okay, and it'll be that one, and it's going to be basically GBP JPY, and this is Great British Pound, okay, versus US dollar and the Japanese yen. Okay, so that's what that is. All right. Now this pair is highly they're both highly volatile, but this pair is really going to move. The volume on this pair is very high. Okay, volume on this pair right here is very high. Okay, this is very high volume, which means it can be dangerous, right? If you take a position, it can go against you really quick. I mean, same thing here, but this one, now the good thing about this one is it tends to trend because it's connected to the Japanese yen. Okay, so the JPY is more JPY tends to trend, which is good because the trend is your friend, okay? The trend is your friend. You say, well, what is trend? Well, trend is when the market is doing this. Okay, so you have a series of you know, higher lows and higher highs, right? This is a trend. This is what's called a trend line. Okay, so when you make your on an uptrend, you want to be buying, right? You're looking to buy, you know, you're looking to buy in these areas, okay? Real quick, there is a something that we use that is basically, you know. Now let me go ahead, and I might as well, since we're talking about yeah, just this one doesn't tend. This one does not tend to trend as much right here. But the JPY tends to trend. But the good thing about the British pound USD is that basically you know, the dollar, right? The US dollar. There's something called the DXY, right? Now, let me just the USD index equals DXY. Now the DXY is the US dollar index. That's going to be an independent of, it's not a pair, it's just one, it's just the value, what the DXY is, what the dollar index is, the US dollar index is it's the average value of the US dollar weighted against all the other currency pairs that it trades with. So you have several major pairs, the USD JPY, the USD GBP USD, GB Euro USD, CAD USD, or USD CAD. You have all these different pairs, right? The New Zealand versus the dollar, so the Kiwi dollar. You have all these different major pairs, but they're all connected to the US dollar index. Okay, so we want to be looking at that. All right, so we want to be looking at these two things, right? Now, it's kind of a crash course, just sort of an introduction. You want to draw, there's certain levels that you want to make sure you draw out. And they're going to be, it's going to be like, somewhat like this. Okay. Now, what these levels are called quarters theory levels. Quarters theory levels are going to be, so if I can write these out, quarter levels. Okay, quarter levels. So like this one would be, for example, 1.22000. This one is going to be 1.23000. Okay. Now in between there, you've got. Well, let me just stick with the black. That way you can see it easier. This one's going to be 1.22500. Okay, this will be 1.22250 and 1.22750. So you see what's happening here. You have 1,000 points or 100 pips. 1,000 points is 100 pips in between here and here on this chart right here. See? And then in between we have what's called, the half quarter. This is a whole quarter, this is a half quarter, and this is a quarter right here. So you see how we have 250, that's a quarter. 250 points is 25 pips. So 1 quarter, 1/2 quarter, 3/4 of a quarter, and then a whole quarter. So what you want to look at is for price to sort of bounce around. You see how it comes up and it bounces off of this and it comes down and it gets just below this, comes back up, retests here, boom, bounces off that, comes back up, oops, now it's going up. Do you see what happens? And if you look on the charts, after you draw these levels out and go on and do some looking at past price data, and you'll see how price bounces around these levels. Okay, I'm run out of room here, but if I can find a way real quick to draw something, I want to show you a basic idea here. Okay, you have what's called candlesticks. Okay, so you have these candlesticks. Right now, it's important to understand how these work. Now, let me draw a little mini. Get this out of the way. We'll just pretend that I did that. Okay. So let's just draw right here in this little box. Okay. We have pretend like we have a little box right here. All right. So we have this. Let's see. We start here. And it's like, and the price move like this. Okay. So now, let's see, it opened. Okay, so it opened here. Came back down. I believe it would be, this would end up being something like that. Okay? So you see how, no, hold on. Let me, but it's important, the whole point of what I'm trying to say is, you need to understand candlesticks at a fundamental level. There we go. I believe this is it. Now, the reason for this is you have the open here. You have the, let's see, the high, You have the high here. Okay, and then you have the close. So the open, which is the same as the low in this case. So the open and the low is the same. The order that you do it is open, high, low, close. So open, high, low, close. I think that's right. Open, high, low, close. So open, high, open, high, and the high and the low are the same on this one. Okay, so that would be that. Let's do one more, because that, you know, it might sound like we need to do more of this. Let's see. So we have, no, let me do it backwards. Let me draw the candlestick first. We'll do a doji. So this is like a little doji. Okay? And the only reason that I'm doing this is because what I want you to understand, you can study candlesticks on your own, but no, not many people talk about this, and this is why I'm talking about it. You have to understand, this is the low. So in this case, price opens here, it makes a low, okay, then it comes up, makes a high, and then it closes right here. So this one's going to make more sense for you. This one, I sort of might have screwed that up. I don't know. Let me see. Let's focus on this one. So here you have the open, the high, the low, and the close. Now you see how that candlestick was formed? You have to understand the motion, right? The motion that created it. Boom, 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 right? So when you see this candle, what you need to be thinking in your mind, in your brain, in your head, is the movement, okay? Because when you're looking on dailies, when you're looking on daily time frames, 4-hour time frames, you want to be able to understand how price is moving, and even on smaller time frames too. On all time frames, any candle, all candles, you want to be thinking like this. So you want to think, all right, we have a open, then price went down, then price went up, and then it closed above the open, and that is why it's green. It would be red. Let's do a red one. Good opportunity here to erase this one, which was, I think, confusing. The best way, I've never done this before. This is the first time I'm doing this on video. Let's say we have a red candle. We'll just do a red doji. We'll do a red doji. What's the difference? What's the difference? Okay, the difference is this. Difference is, this is the open up here. So it opens, you have a high, and you have a low, and you have a close, right? You see that? So you have this open, you have this high, you have a low, and then you have a close. So you see how that works? So you can see the open, okay? The open, the high, the low, and the close, okay? So it opened here, boom. Hit the high, come back down, hit a low, and then it closed below the open, which is why it's red. Okay. All right. So let's. All right. So let's do something with now you understand how candlesticks are formed. What it needs to happen with the candlesticks is, what you need to do is go and study the candlestick patterns. Okay, so go and look that up. You can print off, worksheets like right here. Okay, then this is good. I need to show y'all this. So you can print off these cheat sheets like this right here. That's going to show you, your candlesticks. So you got another one right here. And then also, let me see, hold on real quick before I go to talk about patterns. Okay, now this is where I got the idea to study the movement of candlesticks. You can find this one online if you look for it. It's just called Candlestick Patterns Cheat Sheet by Tradeciety, TRADECIETY.com. But anyways, this shows the movement, right? You got the open, low, high, close. This one, you see this one? Okay, you have the open, high, and the low and the close are the same. The low and the close are the same. Okay, now on this one you just have a open and the low are the same, and the high and the close are the same, right? Then on this one you have open, low, high, let's see, the movement. It's just basically showing you the movement here. Like, let's look at this one. Open, high, low, close, right? And that's how this is formed. Remember? And this one would be open, high, low, close. This one would be a red, right? Because the close is lower than the open. Okay. Now, let me see. I actually made a thing. I don't know where it is. It's not here. Somewhere. If you go to blakewills.com, you can find it on the Forex section. This is, basically to get you started. So you want to actually go and study these. There's really only two types of candlestick patterns. You have continuation patterns, which is the most common, and then you have reversal patterns. But let me explain something. A reversal pattern is best used as a trend continuation pattern. What do I mean by that? Okay, what I mean is if you have a continuation pattern here, all right, good, it goes up. But if you have a if it's going down and you have a continuation pattern, it's going to keep going down, right? So if you had a continuation pattern right here, as it was going down, it's going to keep going down. What you want to see is a reversal pattern right here, because what's happening is it's going up and then it's correcting itself. The market is correcting itself. Then it goes up and then the market corrects itself. And then it goes up and the market corrects itself. And I want to draw real quick. What kind of color do I have here? Let's see. Do I have a blue color maybe? Okay. That's a purple color. Blue color. Purple. I don't care. Whatever. It's fine. But what you can do, you can identify areas on the chart that are what we call, basically supply zones and demand zones. So demand is when price goes up and it hits an area that causes it to start selling. you hit a demand zone, like right here, there's a demand zone, boom, sellers, right? And then, you know, there was probably a supply zone over here that caused this to hit, because this is actually the way that I drew it. It's not actually on. It's not actually on a key level, which, you know, it doesn't. They don't always perfectly react off of a key level. There's your buy that you're looking for, but yeah. So, anyways, sometimes it'll dip down below a key level, but if you look to the left, there might be some indication. And also another thing to look for too is what's called liquidity. So sometimes what will happen is you'll get a situation where, like for example, if the market came up here and basically, I mean, I ran out of room. I ran out of room right here, but basically, if you had a situation where, let's just say the market, let me just draw over this. Let's just say the market came up here, okay, and then was testing, maybe you have some sellers, right? Had some sellers, and then boom, you had a big spike down, and then it just took up, boom, to the upside and just ran up like that. Now, what this is because you had these people buying right here, and people buying right here, and maybe people buying right here. So you had these three buys right here. This is an area where people would probably be buying. Be buying here, here, here. And what happens is these people who bought probably have their stop loss set right here. Okay, so what happens? Boom. Who's buying right here? Smart money. See, these people just lost all their money, and now smart money has gotten in at a better price. They've taken out this liquidity. There's a concept to understand about liquidity. So basically, for someone to buy, there needs to be also a seller. So anytime someone buys, there's someone on the other end selling to them. It's a contract. The market is a series of transactions. People buying from sellers, and sellers selling to buyers. Okay, so you have buyers. When these buyers get stopped out, a stop loss is where you set your maximum loss for the trade that you will accept. If the market goes below there, you take a loss, or maybe not a loss, but so if price had went up and then you moved your stop loss up, maybe you break even or come out at a profit. But stop loss is what triggers the exit from the trade. Now, when a buyer gets stopped out, they become a seller. So what happens is all these people get stopped out. Now there's all this liquidity right here. There's all these people who just got stopped out, and these buyers just got stopped out, and the buyers just became sellers. Now, smart money will come in and they will buy from these sellers. Boom. And here's the other thing. When the market reaches a critical level, like such as this, and a lot of people are trying to sell that, right? And we'll use red for sell. A lot of people are trying to sell this, right? What happens is those sellers, a lot of times, sometimes what can happen is these big money buyers right here can just come up, boom, and just buy from these sellers, and that will cause the market to go up also. So there's different factors that you can look at. So you want to look for you want to find little cheat sheets like this and learn what do the continuation patterns look like. What are supposedly neutral patterns? What are your reversal patterns? And you can study these, and when you see them in real time on the chart, most of the time you have time to go and look and pull up these cheat sheets and say, okay, what's going on? What does this look like? Okay, it's this thing or that thing, and boom, there it is. So there is a lot to learn, but it's not that. I don't want to say it's not that bad, because I mean, here, let me explain it to you. It's what it is it's all mostly psychological, right? You have the knowledge is important to understand how candlesticks work, understand your key levels, how they work, your quarter levels, understanding the patterns, candlestick patterns and everything like that. But 90% of your trading is mental or psychological. And so let's just kind of sum it. Let's do a little summary here before we wrap up. Eastern Standard Time is your New York time zone. That session starts at go time is 9 a.m. EST. Okay, that's for the U.S. session. Okay, now the British session opens British session opens, I believe, at 3 a.m. Eastern Standard Time. So, you want to be in the market. I usually say you want to be trading from this is your time to trade, 2 a.m. to 2 p.m. That's your optimal. Now that's Eastern Standard Time. EST, right? You got it? Everything's EST, EST, EST. Okay? Okay? Okay. Eastern Standard Time. You want to look for news releases. You want to look up your news, economic news on Bloomberg.com is a good source. You can also use FX Street. But you want to keep a lookout for news releases. And you want to kind of be careful around news releases, right? Now, most of the time, the news will already be factored into the price movement. Like if the news is bullish, a lot of times the market will start moving up before basically, before the news gets released. So now with these pairs right here, I want to just see if I can explain real quick. With these pairs, you have, when you buy a pair, you're buying you're buying this, okay? You're buying this, all right? When you're buying, okay, when you're buying, all right, you are selling this. So I want to keep it real simple. When you're buying the Great British Pound and you're selling the US dollar, okay? It's the opposite when you're selling, okay? When you're selling this, the base pair, okay? And you're buying that secondary pair, okay? So you see how that works? When you're selling the pair, you're really selling the pound, and at the same time you're buying the yen, okay? So you can look at that. That way, when news comes out that is bullish, this is where some people might get confused. When fundamental news comes out that's bullish, okay, for the US dollar, right here, for the US dollar index, for the dollar. This is basically, you can think of the dollar, the USD. When news is bullish for the USD, when the dollar index is going up, okay, at that time, what you want to be doing is, this is a little bit confusing, but let's think about this pair, okay? Pretend that this pair is here, okay? So instead of this seeing JPY there, just pretend that this is USD right here, okay? So if the dollar index, the news is bullish for the dollar and it's going up, what you want to do is you want to sell the pound dollar, right? You want to sell the pound dollar, okay? Let me actually, it'd be less confusing if I say the news is bearish. I don't know why I said bullish. Let's say if the fundamental news is bearish for the dollar, okay? If the news is bearish for the dollar, okay, if it's bearish, all right, then it's just like right here, okay? What you want to do is you want to sell the dollar. If the dollar's going down, you want to sell high and wait for it to go down and liquidate that position. That's called a short, or shorting the market, okay? When you buy, it's going up, that's a long. When you're selling, going down, that's a short, okay? So what you want to do, if the news is bearish for the dollar, then you want to buy the pound, right? Because when news is bearish for the dollar, it's usually bullish for the pound. You see, they're battling against each other. It's like a war, okay? So when there's good news for the dollar, when there's bad news for the dollar, it's good news for the pound, right? So if the dollar's going down, the pound is usually going up. You see that? And that's how you want to think about it, okay? So I know this is a lot right here. I know that we talked about a lot, covered a lot. The video is only 40 minutes right now, but I ran out of room and I really want to make this video, just this, what I can fit on the board. I think I fit a lot on here. I'm sure that I don't want to forget anything. But here, let me just, I need to give you this piece of information, okay? You need to be patient. You need to be not eager, okay? You don't want to be eager. You want to just sit back and chill and wait and get a book to read or something. Get a book on trading and read that, or do whatever. But you need to not be impatient, right? So you can get different books This is a good one. And then this is the gold standard for learning about candlesticks. This will teach you, this is more advanced. This teaches you about the Wyckoff method, which is talking about liquidity. Like we talked about a little bit about liquidity, like what happens here. That's what that Wyckoff is going to show you. Another gold standard book. This book is going to be the gold standard for technical analysis. Okay. This book is the gold standard for technical analysis. Okay. And then this is an interesting book. You know, and this is a good book. It's got some good concepts in there. Pretty cheap, actually. So if you just want to spend $10 and get a book that's got mostly everything in it, that would be the one here. You can get that on Amazon. So I'll show you the books. These are all the books that I'm currently reading right now, all at the same time, because you know how I do. But yeah, these are my books. These are not all my books, but these are the ones that I've got in my hands. I'll show you one more. I got this one also. And then one more thing I want to show you is this. Now this brings up an interesting, this is a journal, a trade journal. This trade journal brings up something that I was about to forget to talk about. So I hope you can see this. The light has blinded my eyes, but first of all, don't give up. See that? Don't give up. That's on every page. See? Don't give up. Now, what we're talking about is multi-time frame analysis. So looking on the monthly time frame, okay, first, and then looking at the weekly time frame, and then looking at the daily time frame, and the 4-hour time frame, the 1-hour time frame, 15-minute time frame, and last but not least, the 5-minute time frame. And what you want to do is you want to make your notes right here. Is it bullish? Is it bearish? What kind of candlesticks you can draw out? Maybe what the chart looks like, or what the candlesticks look like right here. All your information that you need for this, and you can get that dialed in as you go. But the concept here is to do multi-time frame analysis. Now, a couple of indicators that I use, and I'll show you some more in that book in a minute, but indicators, I only use like a couple of them. Stochastic Oscillator. Stochastic Oscillator. Stochastic Oscillator. Moving averages. That's going to be actually on the chart. The stochastic oscillator will be below the chart. And then volume. So on an uptrend, you want to have higher volume when it's going up. So if you have your volume down here, it should be higher when it's going up and should be lower on the pullbacks. And then the volume should pick up on the uptrend again. It's the opposite for a downtrend, but volume is more important for price to go up. It's harder for price to go up than it is to go down, because price can just go down basically on its own inertia or its own, just take my word for it, it's easier for a price to fall than it is to go up, especially when we're talking in terms of volume. So, but these are just a few things I use. Stochastic oscillator, I always use that. I always use moving averages, and I always use volume. Now there's something that I'm starting to use that's basically called on balance volume. Okay, and I'm starting to look at that to possibly use. And then there's a couple other things that I don't really want to get into right now, but it's got to do with like institutional type of stuff, accumulation and distribution. But that's sort of something that even I don't really, I haven't got much experience with that indicator, so I don't really want to talk too much about it. But so those are kind of some of the indicators that I use. Those three I always use, and then I'm starting to play with this one. But let me get back to this book. So this book has, you know, what day it is, right? Currency pair you're trading, your risk to reward ratio. Sorry. It has the currency pair you're trading, the time, you know, whether it was a win or a loss, your risk to reward ratio. You know, you take your notes. To be honest, I haven't started using it yet, but I should. I'm showing you in case you want to get it for $20 on Amazon. But screenshot taken and archived. You know, are you organizing your trading? How serious are you taking? What session did you trade? The London, New York, London, or Asian? What indicators did you use? What was your entry strategy? Right? And then I guess, I don't know if it has like, should have an exit strategy somewhere. But just remember, don't give up. But you can look at that. You want to pause the screen and take a screenshot of this. You can look at it. But now the last thing I'm going to say, I think, is trade on demo. Trade on demo. Trade on demo. Go to, I use AAFX trading. Okay. This is what I use. Okay. So. AAFX. Trading.com. Okay. Trade on demo. Okay. Demo. And trade on demo. It's going to be a live account. What I mean is market. The market is real market data. Use MetaTrader 5. Okay. MetaTrader 5. Okay. MT5. MetaTrader 5. Okay. So I don't have any room here. MetaTrader 5. This is what you want to use. Right here. MetaTrader 5. Okay. And then AFX trading, link those two accounts, and then start trading on demo. And then you can actually trade on your phone, or you can trade on your computer. If you have a MacBook Pro, you're going to want to get a mouse so that you can click and right click. If you have a Windows, you can just use that, or if you just have your phone, you can use your phone, although I do not recommend you using just your phone because it's not optimal. Because on your phone, you're going to forget to look at stuff like the trend lines. You're going to forget to look at past liquidity. You're going to forget to look at past support and resistance zones that are not quarter levels. Now, most of the times, your support and resistance levels will be quarter levels, but not always. Sometimes they will be in a weird spot or whatever, something like that. So, but this is to kind of get you started right here. Hopefully makes sense. Now let me just give you some real basic, simple, how you can kind of think about approaching it. So you wake up in the morning, maybe you wake up at 2 a.m., okay, and then the market, the British session opens at 3, so you're looking for a trade. What you're doing in that time, in that hour, is you're drawing trend lines. You're analyzing the previous past price action on all time frames, monthly, weekly, daily, 4 hour, 1 hour, 15 minute, 5 minute, all the time frames. And you can take this stochastic oscillator, and on MetaTrader 5 there's at the top left in the options and the settings, you can look and find where it shows doing vertical screens. And at the bottom you have the stochastic oscillator. If the stochastic oscillator, if it's saying it's all oversold, everything's oversold in all the time frames, then sometimes what that means is like you're up here, right? So you're looking to see, well, we're going to get a correction, right? And sometimes you'll get a big correction like that before everything is, I said overbought. Now, down here, everything would be oversold, right? Oversold. So you're going from all the stochastic oscillators are overbought, all the stochastic oscillators are at the top, like that. And what you'll see is like the small time frames, like the 5 minute will start to go, and then the 15 minute will start to go down, and the 1 hour will start to go down, and the 4 hour, and sometimes the 4 hour will just do its own thing, and the daily will do its own thing, or stay put, and then it'll just, the action will happen on the 5 and the 15 minute stochastic oscillator. But like here, you'd be like, okay, now it's the continuation of the 4 hour stochastic that hasn't gone all the way up to overbought yet. It's still going up. And the 1 hour is like, okay, it started to go back down, but now it's going back up. So the stochastic oscillators are very important. Kind of look at what's going on. Moving averages will be on the chart itself. And you kind of want to look at those and be aware of what's going on with those on all the time frames and stuff too. Volume, always check that. Make sure that wherever you get in, or wherever you're thinking about getting in, you want to make sure the volume is still heavy in the direction of the trend that you think if you think it's an uptrend, you want to make sure the volume is still heavy when price is going up, and lighter volume when price is going down, like a pullback. Now, we don't really have room to put Fibonacci retracements on here and stuff, but a Fibonacci is basically, you would draw Fibonacci in an uptrend. You would draw from the low, and you would you click here and you drag it up to the high. Okay, so maybe it would be like this. So you have a low here, and then maybe you would drag the Fibonacci, okay, from up here, from down here, you drag it up to here, right? Fib, right? So you have your fib, and then you have your different fib levels. Like you got your 50, okay, this is your 50, okay, and then this would be like maybe your, I know it's not exactly right, but this would be like your 61.8 right here. And so a lot of times price will either come down, try to react off the 50. I know it's not proportionally right, just forgive me on that, because you know it's definitely not proportionally right, but I'm just trying to get the point here. So sometimes it'll come back, because it would have been much higher, and then the 50 would be like, you get what I'm saying? I drew it not proportionally correct, but just bear with me here. So, but a lot of times it'll come back to 61.8, the 50 bounce off, or the 61.8 and bounce off, and sometimes it'll react off the 50 and then come back, just like right here, and test that 61.8 before going up. And then sometimes it'll even go up and then come back, bounce off the 50 again, come up, bounce off the 38, and then keep going up like that. So those are levels, key levels to keep in mind. Use the Fibonacci retracements. On an uptrend, you're dragging from the low here, up here, release, and then you'll have your Fibonacci levels. You can use that. So I feel like we pretty comprehensive here. Watch this video again if you need to. We're getting up on 1 hour. So if you have any questions, leave them in the comments down below. Let me know. I'll be glad to answer them or make a video on anything for you guys if you are wanting to know something. But yeah, this is about the best that I could do here for you. You know, I feel like if you can get this video and you've got a pretty good grasp on what you need to get started, you know, it's real important. I just moved the camera, my bad. It's real important to get a book like this and start learning, because you can never know too much about your job. And so there's a lot of different concepts, you know, we could talk about. There are like lots of stuff, you know. Price gaps, you know, where you have like a gap in the market where it went up too fast, and then it will have to come back down and fill that area in. Then you have stuff like Elliott wave theory, time cycles. We didn't even talk about money management and risk management. Risk management is probably, you know, the place that I should have started this video, because risk management might be the most important thing. And let me just give you the real basic what you can understand about risk management, because we got about 30 seconds left in this video. But risk management, here's how you can do it. Here's how you can just make it real simple, okay? When you get ready to take an entry, the first thing that you need to do is find your stop loss, okay? So you're going to say, well, I'm going to put my stop loss, let's see, if I take an entry here, okay, I'm going to put my stop loss right here, right? I'm going to put my stop loss right here, okay? So you put your stop loss right here. So your stop loss is right here, okay? Now, let's just say you had moved it to break even. You had taken your entry, you had bought right here, okay? You bought right here. Now you took your entry. Now you move your stop loss to break even, okay? This is your stop loss. It almost got hit, but it did not get hit. Okay. Now the reason that you do this, you say I'm going to place my stop loss right here, and then now you can calculate your position size based on where your entry is. Your entry. So the first thing you do is you find where your stop loss is going to be. This is the mindset that you need to have in your head before you place a trade, okay, or a buy stop or a sell stop. You need to know, you need to identify where your stop loss is going to be, okay. So my stop loss, I know where it is. Okay, now where's my entry? Well, I'm going to try to take an entry on this level right here, okay, and then my stop loss is going to be here, okay, and then my entry is going to be here. Now I can calculate my lot size, okay. So what you want to use is a position size calculator, a position size calculator. Position size calculator, okay. Position size calculator. But the mindset that you want to have is, don't just go in there and randomly place trades because you're gonna place one, you know, whatever here, and then boom, you're gonna get stopped out. Whereas if you say, well, I missed this entry, but I want to get in somewhere at a good price, and it's gone up here, but you're like, well, maybe I'll get in here and I'll place my stop loss down here, right? Get in here, and then oops, I got stopped out. You know, and whether you get in again, that's your choice. But one thing to be aware of is the pound dollar loves to take liquidity before making big moves. Okay, it loves to grab liquidity right here before going up. Price tends to move from 1,000 level to 1,000 level. So if it starts here and it comes up, it's probably going to continue going up unless some fundamental news acts upon it, some financial, economic, world, political news acts upon the market sentiment changes, the market psychology changes, and it doesn't just change quickly. It doesn't just go from an uptrend and then all of a sudden it's just we're in a downtrend. No, what happens is, and I don't really have room to draw it, I think I maybe can find it in this book real quick. There's a real important concept here that you need to understand, and this is what this book is good for. See, it shows it right here. So you have I think a little bit shows it here. You have an uptrend going, and then all of a sudden the degree changes, right? Before it goes down, right? You see that? The trend is going up, and then it flattens out, and then it goes down. So that's just one example. There are many more. Let's see. So like, there are many more examples. But there's all sorts of stuff to learn. But this is a good book. So anyways, but yeah, this is pretty much the video here. It's about an hour long now. And yeah, so I don't want to overload you with too much information, but just realize that the trend doesn't change automatically. Like you'll have this, you'll have it going up, and then the trend line will gradually, it'll start here, and then get towards the top, it'll start to flatten out, and then sometimes it'll keep going. Okay? So sometimes it'll come up here, and it'll flatten out for consolidation, and it'll keep going. But sometimes, if you see we get a lower low, or in a lower high, then it starts going down again sometimes. But there's a lot to learn. Key things to look for are, like I just said, so I'm running out of marker stuff, but this would be like a higher high. This would be like a higher low. Then we have another higher high, and then another higher low. Those are key things to watch for in a trend. Higher high, higher low, higher high, higher low, and the trend keeps going. If you start getting lower lows, see, because we had like a higher low and then a lower low and then a lower low, but it wasn't lower than this over here. It was still a higher low than this one. And that's where you have to, that's why using a computer is good, because you can see a big screen and you can really take a broad view of the market, kind of get the big picture. It's sort of harder to do that, not impossible, but if you have good glasses, like me, if you need them, and then you can use the glasses to see what you're doing on your phone. But yeah, so there's a lot of stuff to learn. You just need to, one website I can recommend is called Baby Pips, okay? babypips.com. I don't get any affiliate, anything for anything, but that's a good website to get your basic Forex knowledge and stuff. It's a very cool, funny, hip, cool, neat, awesome, interesting, fun website that I really enjoy and I really like. So anyways, there you go. Let's do a little quick summary. Okay, you have your time zone, you have your pairs, you have your MetaTrader 5, you have your knowledge about candlesticks, you have what's going on, you're looking at what's going on the index. There's a Great British Pound index, there's a US dollar index, there's a Japanese yen index, okay? GBX is the one for the Great British Pound, okay? GBP index equals GBX, okay? So you have that index, okay? And then I think it's JPX, maybe. JPX is the one for the yen, Japanese yen index. So you have that going on. You have risk management in mind. You're using your position size calculator. You're finding your stop loss. You're identifying the trends. You're looking at the reactions off of the key levels. Okay. You're looking at what the candlesticks are doing. Is it a bullish candlestick, a bearish candlestick? It's on all the different time frames. Okay. You're being patient. You're sitting back. You're relaxing. You're not being quick to take an entry. Okay. You're waiting on price to come to you. Okay. You don't want to get in early. You want to get in. You know, it's better to get in late, because think about this. Think about this right here. It's better to get in late once price starts going up after the takeout. Now, it could just go. And if you do miss it, then you miss it and whatever. But sometimes what you can do is you can just take an entry, make your stop loss acceptable to you. If it crashes down, take another entry, boom. Maybe you can do a break-even stop loss. The thing is capital management, making sure that you are continue to be able to trade. That's why I said trade on demo. I mean, I can't emphasize that enough. You need to be trading on demo. Okay. Demo. Okay. And I can't emphasize that enough. Right? Demo. Okay, so, but yeah, you know, it's just practice makes perfect. You know, putting it all together, learning how to use your indicators, learning how to trade, learning how to do it, practice. You know, I've been doing it for a year now, and I spent the first 6 months using the wrong system using some system that I basically made up. And it wasn't until the beginning of this year that I just started using the quarters theory. Okay, the quarters theory, that's where we get our quarters levels. And that has helped me a lot. Okay, a lot. Now, something that I didn't cover in this video, but I have covered in other videos, is you have major quarter levels like your 1.0, your 2.0, your 1.5, your 1.25, your 1.5. Like, you have bigger quarter levels on a bigger scale. It's kind of, so you have, this is a 1,000, right? But you can do the same thing on the 10,000, right? So, like, it would be like 1.2, 1.3, 1.2, 5,000, right? 1.2, 2,500, 1.2, 7,500. Do you get what I'm saying? So this is a small time frame, 1,000 points, space, 100 pips, and then your next time frame would be 1,000 pips or 10,000 points. Okay, so because on a larger time frame like the daily or the weekly or the monthly, you'll see price reacting off of those bigger 10,000 point or 1,000 pip increments, bounce zones, quarter levels. They act like magnets that attract and repel price at the same time. A lot of times, if you get above this level, like I said, it'll just keep going. The same is true for a downtrend. So to keep the big 10,000 point, 1,000 pip time frame in perspective, okay? Now use different thicknesses. So when you're dealing with the 10,000 level, you want to use the thick lines for all of it. Same colors. Red for your whole levels, orange for your half levels, and green in between your whole and your half. So that would mark your quarter levels. So you want to use the different colors. That is going to help you to see what's going on. Sometimes the 10,000 levels will overlap with the 1,000 point levels, and so you just have to make sure that you emphasize the 10,000 levels with the thicker lines. Should be the same colors. Anyway, listen, this video is getting a little bit long, and so I want to go ahead and wrap it up. I was trying to just do a summary here for you, but don't forget about your Fibonacci's that you can use. And there's just so many other different things. There's harmonic patterns. You can go to Trading View, and then they will have basically where you can use indicators, and you can find a harmonic pattern indicator. So go to Trading View.com, okay, tradingview.com right there, and that is how you can basically go on there and get an indicator that's called harmonic patterns, okay. So I don't have any more room right here. Harmonic patterns, okay. And then you can also, there's a quarters theory, quarters level indicator on there as well, okay. So and then there's another one on there too, I'm trying to think what it is called, but anyways, that should get you started. Yeah, so there you go. You have a crash course here for you of just how to get going and Let me try one more time. Don't forget about the trend lines. Never forget about the trend lines. Never forget, okay? Don't forget about the trend lines, because you want to, like I said, you want to be buying here at the trend lines. You want to watch for breaks of the trend lines. If it breaks down below the trend line, it could be going down. It could just be a fake out or something, trying to get people to sell so that the big money players, the market manipulators, have someone to buy from, because they need sellers to buy from. So sometimes they'll trick people into thinking that it's a seller's market, or that it's a bear market, or changing into a bear market, or that it's going down, so that they will have someone to buy from. But yeah, so anyways, I guess that's about it. But yeah, so wake up in the morning, look at all this stuff, and get on demo, and sit back and wait for your price. Okay, you need to be thinking in terms of price levels, instead of just, oh, let me get in on this action. Oh, look at it moving. Oh, it's going up. Oh, it's going up. Oh, I'm gonna miss out. Oh, FOMO, fear of missing out. Oh, let me get in. Oh, let me click the button. Ooh, 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 ooh. I want to click. I want to click buy. No, sit back and chill. Okay, just chill. Wait. It's gonna be all right. If you need money that bad, go get a job. Real talk. Okay? Otherwise, chill and wait on price, or just sell everything you own, to hit the magic spot. You can wait on it to take liquidity. It will not always take liquidity before it goes zooming up. Sometimes it will. So you just have to play that by ear. And yeah, so there you go. Don't forget about your higher highs and your higher lows, and make sure that those continue. There's a whole lot more than this that is to be learned, which is more than I can cover in a 1 hour and a half video almost. So anyways, but that's pretty much it. But yeah, I mean, if you like this video, don't forget to subscribe. Go ahead and show some love and subscribe, and leave a comment. Let me know what you thought. Let me know all your questions, and what your experience has been trading. Let me know in the comments. Comment down below. Let me know how everything's going for you. And then hit the like button if you like this video, if you appreciated this video. So like, comment, subscribe, hit the bell notification so that you get all the good stuff when it is released. And hopefully this helps you. Hopefully this helps my friend Grace in Africa, who I made the video for. Times are tough for a lot of people, and hopefully this video can help. My whole goal, my whole mission for doing these videos is so that you can take $100 and put it into AAFXtrading.com using MetaTrader 5, trading one of these two pairs or a different pair if you want, and grow that into, another $100. And so you can start making $100 a day, and then build up your account and make a withdrawal. That's important. So if you start off with 100, your profit goal should be, something reasonable. Start off with trying to make $25 a day. I know my name is Forex Money Flipper, and so I'm really zealous to flip that account. And sometimes you can take a position here, then take a position here, and then you'll be in drawdown here, but you have this position, so you're in profit even here. So if you took this, you're negative here, but you're positive here. This is a break even. This is a neutral point for you because you took this entry and you took this entry. Now, if it starts going below here, that's where you start being in trouble, and that's where you start getting into negatives. But sometimes you can take the multiple positions, and if you see a little bounce back here, you already bought here, you held this into drawdown because you're break even, all total, net. You can take another position here. Once you see it start going up, you take a position here, boom. Now you're into profits even more, and you can take another position here, but it's dangerous to take another position here because sometimes it can just go back down, or whatever for a little while. You never know what it's going to do. Sometimes it can bounce around in these zones before going up. I just drew this to be an example of an uptrend, but like I said, it could bounce up and down before exploding up or down or whatever it wants to do. So you just have to watch the market, understand market movement, candlestick movement, chart patterns, all that good stuff with your indicators, your oscillators, your moving averages, your fundamental news, and everything like that. So, but like I said, basically, if you have a $100 account, what this is. So you can do a 0.1 lot here, and say it moved 250 pips. That's $25. And if it moved, by the time it gets up here, I know it went up there. But by the time it gets back to here, okay. So you took a position here, you took a position here. Okay, so you're at 250 pips, 500 pips. That's $50. So you took another 0.1 lot here, and I'll just draw this out real quick. 0.1, okay, 0.1, and then you took another 0.1 lot size here, okay, and then you took another 0.1, okay, lot size here, okay. So now you're at 50 profit here, and you take a 0.1 here, you're in drawdown, you're in 250 points or 25 pips of drawdown right here. So you're at break even. 25 up, 25 down, break even. You take another one, it goes up. Now you're back to here. You're at $50 from this one because you're 500 points or 50 pips. You're at $50, 0.1 lot here, $50 from this position, okay, and then your break even here, but you got $25 from this one, so you're at $75 all total. 25 from this one, 50 from this one, and break even here. Now when it moves up here, you take your take profit. This is your take profit, okay. That's your take profit, your TP, okay. So now up here you would have that's 1,000 points or 100 pips. You'd have $100 right here. So from here to here, that's $100. From here to here, that's $25. So 125. From here to here, that's 500. No, let's see, that's 750 pips. You have $75. So what's 175 plus? This is actually 50 pips. From here to here, so from here to here it's 100, from here to here it's 75 pips, and from here to here it's 50 pips. So you'd have 175 plus 25, that's 200 plus, let's see, 175, $225 profit. $225 profit on a $100 account. On a $100 account, $100 you started with. Okay, you started with $100 right here. Okay, $100, and then up here you have up here you have 200. What did I say? 225. 175, 75, and then this is 50. Yeah, 225. So it's not like astronomically crazy, but I think anybody would agree that that's not bad right there. 225 bucks. That is what I mean by flipping your account and Forex money flipper and all that. So now you have 225. Now you can start thinking about, now let me say this. In the middle of the day, that's why I said stop trading at 2 p.m. roughly, you want to try to get out of the market, sometime between noon and 5 p.m. because the market's usually just going to consolidate most of the afternoon, and you're just going to be wasting your time. That's not to say that it can't move or make some moves and stuff like that, but the primary times of movement for these two pairs are going to be between 2 a.m. Basically, you got the British Open at 3 a.m. and then the New York Stock Exchange right here okay and so that's going to be your primary time of movement right here, and then it's going to kind of get into consolidation, which is basically where the market is in a balance, a harmony, where both buyers and sellers are both satisfied with the price for the time being. So anyway, with that, I'm going to go ahead and end this video because my battery is getting low. I don't know if you were even able to, I'm not sure if the recording got messed up because my battery started getting low. But anyways, hopefully you were able to see what I drew. If not, there it is. I'm not sure how long that was going for on the screen there, but hopefully it recorded okay. But there you go. Take a look at that. I'll leave you for a few minutes to look at that. Let me know if you have any questions. But yeah, just in case you weren't able to see, I was talking about the positions here, and then taking a position here, taking a position here, taking profit here, turning $100 into $225. From here to here, it's 100 pips. From here to here, it's 75 pips. From here to here, it's 50 pips. You got $100, $75, $50. It's $225 profit right here. And that's a good day when you can get that done. That's a great day. So anyways, if you like this video, please hit the like button, click it, smash it, hammer that like button, and then leave me a comment. Let me know what you thought. Any questions you might have, your experience trading. Have you used any of this stuff? How did it go for you? And also to subscribe, hit the bell for notifications, so you can get all the good content that I'm producing here to help you turn $100 into $225 and then double that. The next day, your goal should be to make another $100 until you build up your account, till you get like $1,000. Then you make a withdrawal, $900 withdrawal, and then you start over with the $100. You grow that to $1,000, and then so like 5 days a week, right? So you're making like $500 a week to start, which is decent. I mean, that's better. It's better to learn this skill because there's no limit to the amount of money you can make. But you start off slow, you start off small, you start off humble. But you're looking to catch this big trend here. You're looking to catch these big moves from 1,000 to 1,000. The reason why is because you can stack multiple positions, entries as you go. It's important to be patient and to wait for the best price. Don't have FOMO and say, "Ooh, I need to click the button. I need to click the button." No. Sit back, chill, relax, wait for the price to come to you, and wait for the price that you want. Let the market come to you. Let the money come to you. Become a magnet for money. And get in at great prices and then make great profits. You don't want to be in drawdown. You just don't want to be So the way to stay out of drawdown is to wait for price to sort of bottom out on the pullback and go back up, because eventually price will pull back. If it goes up too fast, at a too steep of an angle, the ideal angle is 45 degrees. Price and time. Price being this and then time being this. So the ideal is 45 degrees. So if it's steeper, if price moves up, too steep, then it's going to come back down in order to sort of level out price. And sometimes it'll overcorrect and it'll come down too shallow, and then you'll see, but the equilibrium is 45 degrees. That's the ideal movement of price and time over time. So there you go. Hopefully you learned something. Hopefully you can see everything. Take a screenshot, study that. Go to AFX Trading and TradingView and MetaTrader 5 and look at all this stuff. Get your harmonic patterns, your quarter levels, your stochastic oscillators, your moving averages, your volume. Keep an eye on throughout the day for the dollar index and for the pound index and for the Japanese yen index. Use demo, trade on demo, and understand candlestick movements and how they move. Remember, the green closes above the open. Open, low, high, close, that's green. When it closes above the open, it opens here, goes down, comes up, closes above, that's green. Red is when it closes below the open. So the open, high, low, close. So open, high, low, close. See how that is? And that's red because it closed below the open. See, open, high, low, close. See, open, high, paint it red, low, close. Open, low, paint it green, high, close. You see? And so you're painting it on the way, and there you go. Oh, did you not see that either? So I was trying to say, my phone's about to die completely, but I was talking about these. The reason this is red is because this is the open, then it has the high and the low and the close. So you have the open, the high, paint it red, you get the low and then the close. You have the open, high, low, close, open, high, paint it red on the way down, low, close, right? Now the green is the opposite, right? So you have the open, low, high, close. You have the open, low, high, close. So open, low, paint it green on the way up, and then the high, and then the close. So the open, low, paint it green on the way up, and then the high, and then the close, right? And that is, your movement that you can understand for candlesticks and how they move, and that's so important to understand how that goes. So 2 a.m. to 2 p.m., that's your ideal trading time. Get on there, get it done, practice. You don't need to watch the charts all day unless you're taking multiple entries. That's why it's good to trade the higher volume, basically, of these sessions. So you're trading the British session and then the New York session. Those are, you can kind of break those up. You're going to get big moves there in the British section. You're going to get big moves there in the New York session. So you want to catch those moves. You want to be around when price is moving, when the volatility is high, because that's where you're going to get your good entries. Okay, so that's where you're going to get like entries like this. That's going to happen probably around the New York time zone, but then you may have something like that happen, a big move like this happen on the British, right? So it may happen like this at 3 a.m. or between 3 and 5 a.m., say between 3 and 5 a.m., maybe it moves here, and then at 9 a.m., boom, it takes this liquidity, and then it goes up, and then about 2 p.m., you would have up here, and then it's just consolidating for the rest of the day. So with that, I'm going to let this video be what it is, and I appreciate you watching. Thank you so much. I hope you liked it. This is Blake. I am Blake with also known as Forex Money Flipper. So, like I said, I'm Blake, Forex Money Flipper. Thank you so much for watching. I appreciate it. Hope you enjoyed the video. Hope you got a lot out of it, and I hope that it helps you be successful in your trading, turning $100 into $1 million over time. But start slow, and then eventually you can bump your lot size up from a 0.1 to a 0.2 later on. After you build up your bank account, you make a lot of withdrawals. You start off making $500 a week, right? And then you make a $400 withdrawal on Friday every week, and then you build up your bank account, right? And then eventually you can bump your, eventually once you get to like 5,000 profit in your bank account, not your trading account, you don't leave money in your trading account, you just put the money in there on Monday that you need to trade with, and then you make a withdrawal on Friday. That's how it goes. So, and then eventually once you have say like $5,000 in your bank account, then you can bump it up to a 0.2 lot or like a 0.15 or something like that. But until that time, stay steady, stay consistent, stay on the 0.1 lot, and then that way you can just be consistent and steady, rock steady, solid, reliable. You can be what they call stable. Yeah. And then but you build up slowly your account, right? So eventually you're going to be making $200 a day. Eventually, once you have built up your bank account, then you can move to start with like bump the $100 a day goal up to 150, whatever, or 200, say, whatever you feel like you want to do, but keep it reasonable. Like, okay, because you don't want to go crazy. Remember risk management, capital management, keeping money in your trading account, okay, so that you can take losses. Keep your losses small and your wins big. Cut your losses quickly and let your winners run. Cut your losses quickly and let your winners run. And stack your winners. So once you're like, okay, yeah, it's an uptrend, run that with these multiple positions if you can, right? But if it turns against you and starts looking like it's going down and it's just getting not good, then cut that loss and then try to go for a sell. And that's sort of where it can get kind of like so hopefully you get blessed and you can do good with it. And but pray to God for that, in the name of Jesus Christ of Nazareth, my Lord and Savior, who died for our sins. And thanks so much for watching, and I appreciate it. He rose again on the third day. And glory to God. Amen. Hallelujah. Here we have this. And I appreciate you for watching. Thanks so much. I'm Blake, Forex Money Flipper. Thank you so much for watching.